Alright guys, glad to have you on board again. So today I promised that I would try to find some time to record another video if we had the volatility that was expected back in the previous recorded podcasts, and turns out we had them. So, you know, summer was kind of pretty silent and boring for many of us, including me, in terms of trading activity, but there were still some trading scenarios kind of lurking in the background. So these to me have been activated today. No shit Sherlock, they were all previously shared in public recorded sessions like these ones, so you can scroll through all the previous videos to have a look at this and verify, of course. So the thing is, this structure was pretty well explained into the fact that we didn't really know if the second flow was terminated or not, if it was still going on, because to have one, we need to have a fully rejected third range boundary, and then normally up to its maximum retracement, these movements generally tend to go right down to the lower Bollinger Band, which generally offers an entry point for the third and final flow. So that is the motion which we're in. That's the reason why yesterday all my alarms have been ticking when I was right in front of the computer, lucky for me for one time, and I was able to trigger those trades. So I'll go straight to the conclusion. To me, yesterday has been an entry point on Ethereum, Atom, and Bitcoin, and I'll explain why on this video. But first, I think, without spoiling to the trading activity, I think most importantly some recap needs to be done regarding the overall portfolio exposition, because I still see many of my words being distorted out there, and I goddamn don't like that. So here it is, okay, breaking down all these things, color-coded, history to prove it. It's not something that's been made up, not changing my mind or switching stuff, okay? So this is really true things. You can scroll back in time, you've got the proof for all of it. So here it is. The black color in here stands for the assets that have exposition that is guaranteed up to at least mid-2024. And some of these assets even have a guaranteed exposition till 2030, which among those are just two assets, Bitcoin and Ethereum, which will never be sold for a portion of the trades until 2030. Points. End of the discussion. Some Ethereums I'm never going to sell ever. I've got a validator and I'm never ever going to pull it down. It's just simple as that, okay? On the other hand, there are Bitcoins which, well, by 2030 I'll question their value or not, because remember, Bitcoin is a store of value and it has utility at certain portions in the time of macro cycle, and that's it. Well, you don't just store value in gold, for example, in an economic expansion cycle. On the other hand, when there's too much leverage in the system, when borrowings far exceed the revenues and stuff like that, well, in that sense, that's the moment in which you want to go back to hard assets that serve absolutely no utility in the real economy, but they do offer store value. So Bitcoin to me is the safest asset to get ahead of 2030, because some big changes are expected in the next decade, and I'd rather like to have Bitcoin as a safe insurance. But of course, could be wrong. Until then, this is why I think Bitcoin has value until then. Okay, so that sets Bitcoin and Ethereum aside. Though the rest, why are they all black? Is to mean, well, there are some that I intend to keep up to 2030, but they will require absolute validation being reached before the end of the intermediate cycle, which is this one. This is mid-2024. Of course, these are just rough cycles. These can extend for 3 to 6 months in both directions. So the thing is that, like I've always said, mid-2024, at the later stage, I will have to make myself a decision. That should correspond with the end of this current weekly bullish cycle, which is pretty mature, by the way, and we'll see all about that. That means until that date, I will not strike a decision whether it is for Atom or Chainlink, which and Monero as well. Look, Monero, I've always made it clear, I think I'm never going to sell it either up to 2030, but I still would like to see some validations before then. That means I'd like to see a resistant context being reached out to, which is the sign for the men. So that's really the way it goes, okay? All of the other assets that are in light gray, okay, are assets that in any way are going to be assessed by this 24 schedule mandatorily. That means some of these assets could potentially be extended to 2030, but anyhow and anyway, there will be profit takings performed on these. Okay, the black ones are the ones that, well, if I'm correctly surprised with those assets in 2024, I'll keep them and extend them until either their targets are reached or 2030 is reached. On the other hand, the light grays are, by 2024, mandatory profit taking, almost 50% guaranteed, eventually more depending on the signals, will be performed. Few of them who validate the thesis will eventually be extended to 2030, and that's it. All the others will be 50 to 100% profit taking, and I'm done with them. I'm going to go back to some safe storage for the next consolidated cycle. Okay, that's where the way it goes. Okay, that's the strategy. The reasons leading me to do this are all the models that I've shared previously, which are a combination of adoption cycles, which are a combination of, damn it, where are they? These ones, okay, which are breakthrough S-curve technology cycles. The other models are Armstrong cycles, okay, economic cycle on the economic confidence model. The other ones are, of course, all the models made by, where are they? Let me just get by Ray Dalio, okay, and this is the transition cycle, which means, well, this is what's going to be ahead of us for 2030. Corresponding with the economic confidence model shift in 2032. So lots of things tend to correlate, even though they've been created by different individuals and stuff like that. Okay, that could just be full of shit. I'm totally aware of this. Models are never future forecasting. They're just better guesses. That's really the way it goes. Just like using a speculative strategy that just frames whichever movements you can make into a framework, and repeating it over and over again, the speculative models for investments are required as well. So that's really the way it goes, okay? But there are two separate parts in the portfolio. There's the long-term 2030 investment strategies. There is the mandatory 2024 validations, and there are the rest. The rest, which will be decided anyway by 2024, whether it is a gain or loss. I will not overthink things. I will probably take profits or losses for many of these light gray assets, no matter which price they trade on. Luckily, they will be trading in a demand area. That means we'll go in the resistant context. Otherwise, well, there will be in the offer area. That means there is an excess supply, and there will be in the bottom area. I goddamn don't know where they'll be. Okay, all I know is that by 2024, my strategy forecasts that they should be demanded. If they are not, I'll take the losses according to this. That's really the way it goes. Okay, I hope this was clear enough. And on top of this, there are the strategic trading speculative strategies who generally exploit these longer-term value investments and value areas of low-risk trading into and decline to lower time frame riskier tradings. These ones are associated with margins. That means I'm borrowing the money to expand on the potential gains. These ones therefore require hard stop losses, true tight management, and of course they do have validation triggers, targets, and all of these things. These are not just random stuff that I do and stuff. Okay, they're all absolutely framed decisions. I have no personal feeling with that. I just repeat the same old strategies. All right, so these have been very well documented all across the board throughout the years. So these are not things that I can change up to my mood. This is really the strategy that I've been offering and trading for years. That's where the way it goes. Okay, I'm not making it personal with Ethereum, Atom, or whatever. I can choose the assets which I'm applying it on, but the strategy remains the same for every fucking asset on the planet. Okay, that's where the way it goes. So applying those rules, I've said I'm going to pick a few assets based on this model that I've shared and some other crypto models. Let's say on an investment strategic, I need to figure out which are the assets that I'm going to target into, because when you invest, you just can't spread out the money to endless numbers of assets. You get a limited supply, a limited amount of money to invest, and you better like to choose in whichever assets you're going to perform those investments, because you're going to buy the real thing. You're not going to use margin. You're not going to borrow the money you don't have. You're just going to use the money you have and spread it into the assets you think have the most potential. Of course, money comes into play as well with strategic decisions, meaning there are still validations and so on. Okay, there are price targets and levels that should be reached. On the other hand, well, whichever asset you pick depends on whichever strategic you have. And just like I said before, on investment, just like trading has a risk management, technical risk management strategies, investment have model-based strategies, which means there should be a model defining which kinds of metrics you're looking for to validate or invalidate the thesis. And that is what I've carefully taken a hell of a lot of time to do over the latest couple of years and sharing this all throughout this nasty bear market. So among those models, this one is the one that comes in for play. That's really the way it is. That to me, it means in the crypto market, there are 6 market shares for value that I can identify. Among those 6 sources of value, I see 2 of them that have already reached out the minimum exhaustion speed or acceleration speed to be the leader in their category. By meaning this, I'm using the market share distribution paritotype law, which is basically if one competitor among the group of other competitors stand to make more than half of the market share distribution, when the second is below 30%, that means a maximum 30% for the second, that means the leader has a leadership position. The first one has a leadership position, and it is literally close to impossible for any other competitor to emerge in the system. Of course, for crypto, we're talking about decentralized system. That means no one can be the leader in its market share if it isn't decentralized. You can try to be a future forecasting shit type leader by centralizing like crazy, and this will just be short-lived because sooner or later your centralized decisions will fuck up and you'll collapse. But the thing is, for cryptos, these market shares needs to be held by decentralized systems, okay? And they need to expand beyond 50% of market share, with a second in line being below 30, okay? To me, that's done already for Bitcoin in terms of store value, meaning that the average type transaction value per transaction, Bitcoin is leading by far any other blockchain, and it isn't going to change. On the other hand, total value locked, I think, is now held and strongly held by Ethereum due to its layer 2 scaling, meaning that the value secured on layer 2 is also secured by Ethereum, which means the total value lock in the Ethereum ecosystem, aka every other value denominated outside of Ethereum. That means inside the Ethereum blockchain, it secures value that isn't Ethereum based, okay? And Ethereum is clearly leading the mark in here by a significant margin to any other competitor in here. So to me, these 2 shares are taken already, and they have sufficient velocity to escape from competition. So Bitcoin, sufficiently decentralized, sufficiently way above the other competitors. So Bitcoin won the battle. Ethereum as well. So these are the assets, like I said, never going to sell Ethereum, never going to say Bitcoin. You can just do whatever the fuck it is. There are, to me, no chances at all, or insignificant chances to see a competitor flushing their game. So I'm in forever for these 2 assets. The question remains for the remaining 4. That means I want someone that is winning the market share of speed, that I rely on to choosing this by transactions per second, which means I want to see someone that relates into having a decentralized network which performs more than 50% of every daily crypto transactions, where the second one will be 30% lower. Will be below 30%. My model says if I get it right, normally this should be the daily active users leader, who should also be the second in line for TPS. On daily active users, we're talking about actively onboarding. That means making trade-offs of UI, UX, and security assumptions to try onboarding new users who will just use this new decentralized system just like they were using regular banking systems before. So this is really like reducing the barriers for entry for users to join the ecosystem without nearly even thinking that they do actually use decentralized technology in reality. So this was really had a lot of user abstraction in here. To me, this is the layer 2 scaling. But the thing is that this is not yet done. They're far from being handled already. So these are market shares to be taken. We can clearly see some leaders today, just like transactions per second with a decentralized infrastructure seems to be led by Proof of History and Solana today, but this is far from being a won battle. There are still some other competitors, and there is no significant velocity in Solana to consider that a won battle. Same thing goes for daily active users. There is a hell of a lot of competition between layer 2s. Few of them will eventually emerge as leaders, and we're far from being done here. I would say the competition for daily active users just got started, and there will definitely be interesting battles all over the next cycle, if there's one, of course. That leaves us with 2 other competitive market shares, which are privacy and cross-chain transactions. That means these 2 are also symmetric in their market share distribution, just like the others are. And in that perspective, that is not just privacy coins and stuff like that. This is using non-public visible transactions and permissioned environments. That's what I'm measuring as a market share. Of course, that's very complicated to say. I mean, that most of the transactions will be non-visible, but we can still see the number of transactions. In the case, for example, of Monero, we can see how many transactions have been processed. We just don't see them individually. or we don't know the contents of those transactions. On the other hand, cross-chain transaction is related to interoperability. That means you need to see an environment in which there are a hell of a lot of cross-chain transactions being performed. Okay, for now, in here as well, there is a leading competitor for this, which is the Cosmos DBFT and IBC Lite clients, but we're far from being over in terms of potential competition. Okay, but that's really the way it goes. All of these ecosystems need to be decentralized. Remember that, very important. So with that out of the way, that means you know everything there is to know. My potential candidates and the black series in here are all potential candidates for the 6 areas. Link is a kind of a 7th kind of arrow in this system, which is basically the public infrastructure that interconnects the 6 areas. That means where there will be an interoperability, Oracle-based interoperability system, which clearly doesn't fit into this category in here. Okay, I'll release an entire report in the following weeks that explains everything about it. But basically, there are 2 types of interoperability. There are Oracle-based interoperability, which means there is an intermediate third party, which needs to be decentralized, which will perform the interoperability between the other layers. There will also be, on the other hand, impossibility for privacy, where the model says the cross-chain transaction ecosystem in question will have quite some layers of non-permission, of permission non-public transaction environments. So that means, according to this model, there needs to be a cross-chain transaction system which isn't an Oracle-based interoperability system, and to me it seems to be for now that the Cosmos DBFT and IBC are the primary candidate for this. But there could be others, like for example Avalanche could have also similar functionalities, though this is still a market share to be claimed. Okay, though that's it. But despite that, all the black ones in here have to be following this model that I just explained. Okay, that's the way it goes for me. Though in this model, okay, that means by the end of this cycle, I need to have 6 black branches, or that means the model is wrong. Could be happening as well, okay? But until then, I'm going to try filling the blanks for these things, and by the end of 2024, I hope to have 6 black assets, eventually 7 with Chainlink if it validates the Oracle thesis. That's really the way it goes, okay? All the rest, the light gray, they will get out of it. Okay, though I've been deciding to choose upon the assets which I think have the likeliest chance to be on the model. Though of course I'm going to be using margin on Bitcoin and Ethereum, and I decided to include Atom in here, but of course that's a personal choice because that's an ecosystem that I know very well about. So I've been using ecosystems which I performed hell a lot of documentation and research on. I really like to trade assets that I understand rather than just gambling on volatility. But still remember that when you do those flow tradings, which are 3 time frames below the low risk strategy, which we have highlighted are either in weekly or monthly charts, hard to distinguish the 2, though we said that the flow trading will be either 1 hour or 4 hour reference. Time has separated the 2 and told us that this was the 4 hour chart, which I'm going to be looking at through the daily chart in here, looking at the trend channel. Okay, remember the trend channel on the daily chart is the 4 hour context. This just gives us a more wider distribution for visibility. So that's the way it goes. We've highlighted this structure, which is the flow structure. Once again, this is not something that I created instantly. This is something that has been well documented over time. It's a strategy that hasn't changed. I'm going to give you the rules. Here it goes. So that's one thing. You need to go from a massive low risk area, which is 3 time frames above, and you're going to have to create a bottom structure. Out of this bottom structure, wait for a first positive flow. The first positive flow is defined by the context pulling outside and above the average, which needs to be either flat or slightly rising. Okay, you just can't have the first flow with a falling moving average, okay? Then the price will keep rising and rising until they find some resistance, which will consist by the first third range boundary. That means after a first flow, profit takings will be performed and prices will validate by retracing further, generally to the moving average or the Bollinger Band, the lower Bollinger Band in the worst case scenario. Any other way, the second entry point on this series can't be lower than the first one, okay? It has to be a high low. Then the second flow triggers, it validates by breaking the previous high point and creates, of course, another price extension with context rising again above the moving average. This time the moving average should be rising significantly until, of course, we get another third range boundary. The pattern repeats itself, but this time around the 4th entry point and for the beginning for the 3rd flow is triggered by the Bollinger Band bottom only. This third flow does the same. It breaks the previous high points and rides its wave until there is a third range boundary. Okay, so that's really just how it goes. Okay, so pretty damn straightforward in here. And if we apply this pattern to this, we've got the low risk strategy in here, the very hard bottom of weekly and monthly structures that we've talked about previously. The first flow was this one, the moving average turning positive, then builds a wicked, weird third range boundary stuff by this expanding wedge in here. We rebounds into the moving average, which is in the middle of these Bollinger Bands. Okay, so the moving average was in here, rebounding exactly on the moving average for Bitcoin in here, starting the second flow, immediately breaking the previous high points, and until then building a third range boundary and gone lower, retracing since then. Build the third range boundary has been retested and failed on a double top structure. It tried to accelerate but failed, and now we are at the lower Bollinger Band. So this is the beginning of the potential third flow. So very simple, and explaining the first introduction that I made. First things first, yesterday I got the alerts when we were trading at this Bollinger Band and instantly bought Bitcoin, Ethereum, and Atom and explain. Okay? I know exactly what type of strategy I'm performing in here. I'm buying for a third flow. I obviously definitely know where the invalidation is, because the worst case scenario means the stop losses, the lower they could ever get on this strategy is in here. Of course, the strategy says I can use the trade channel in here, which is what I've done. Though in here, the stop loss for Bitcoin to me isn't going to be $20,000. It's slightly higher than that. But all I know is that any other way, there is no possibility for a stop loss in here. Otherwise, the previous low point will be broken. Okay, so that's one thing. Those who are bearish in Bitcoin know where to go. They want to go breaking these low points to invalidate the bullish structure. On the other hand, for the bulls, well, that's just the same old story. We have the lower Bollinger Band. The flows should be bullish more than bearish. Let's fuck the bears, and that's it. Let's invalidate the bearish thesis. The bears will have their time to consolidate these three flows by two sets of consecutive bearish flows, which are as well highlighted in the same model. Okay, so we need two consecutive bearish flows afterwards to let the time for the bears to consolidate. All right, though we're fine with that. That means we are due for a third flow before there is kind of a long consolidation of two bearish flows. Remember that in this flow sequence, you goddamn don't know how fast, how long the cycles are. You just know that they need to build third range boundaries and validate there. This would be the third and final flow. So to me, I'll be bullish until we get another third range boundary, which means I'll take my profits and move on to another asset class for speculative behavior. The structure was quite similarly the same for Ethereum. We've had the first flow in here, the second flow in here, retracing to the moving average as well. The second flow triggering very quickly and breaking the previous high point in just a few days. Then we had the consolidation with a delayed third range boundary in here that has been retested. I told you it would be. It's been retested back then, and that's exactly what it is. For those who've been following all across the board, I've decided, as I missed this shot on Ethereum, to buy here and here, decided to take the profit for this position here, and decided to keep the second one open just in case we were surging through the third range boundary, which would be the sign that the second flow would still be in. Turns out that it's not the case because it rejected once again. I got stopped on this position at break-even and triggered another one exactly when I got the alert the other day. That was somewhere like 1577, I guess, or something like that. So this is really what this is. Though I've been exited on one position and triggered another one at a better price. That's where the way it goes. I'm buying exactly as it was for Bitcoin. I'm buying the lower Bollinger Band. Next target is breaking the high point, and you know the story. Okay, so that's what it is. Same thing as it was for Bitcoin. Okay, buying in here, the stop loss is obviously below the previous low point for a maximum distance of the stop loss. Okay, as I bought pretty low, I have this stop loss set in here for my Ethereum positions. Okay. So that's really the way it goes. And now here it goes. I've done the same for Atom, which follows the same kind of sequence, but follows a similar flow variable sequence. This was the long-term bottom for Atom, the lower weekly and monthly context. We've had a first flow triggered out of this when the moving average got flat and prices significantly rose above. Then we've had the third range boundary, and I decided to buy in here right when the FTX collapsed. Happened. Though the thing is that it went through, I thought then that it will go down to the Bollinger Band. Remember that it can do this. It's in the paper. Remember, it can go also to the Bollinger Band in here. So there were entry points on the moving average, and there were also on the Bollinger Band. The Bollinger Band never got filled, and therefore we've retraced to, oh, same story, the third range boundary, which, hey, thank you to the crypto cabal, has been rejected as well, where the others have succeeded. fulfilling a flow, well, Atom failed. So we've retraced in here, back down now to the Bollinger Band, which has been traded 2 times in a sequence, this and this, which both have been bought on my end. So that's really the way it goes. The invalidation is the same as it was before. If it makes new lows, I'm out of the game. That means the system is resetted. If this thing is bullish, it will follow a bullish sequence. There will be more buyers than sellers, and this will orchestrate through flows. All I can tell is that the second flow will just do what every flow does. It will break the previous high point, so the targets are anything but higher than $16 for Atom. It can go higher or lower, I don't guess. It can go much higher or slightly higher. All I know is that I'm going to be on board until there is a third range boundary. God knows no thing. Of course, when the third range boundary occurs, I'm going to let that thing dry out until a third potential flow triggers. Okay? No, every market makes 3 sequences in a flow. It's a sequential pattern that plays itself one by one. So now for Atom, I'm playing for a second flow, and eventually future will say if the third flow will be traded or not. Until then, we're not yet there. Could very well also fail. There is an important factor that I'd like to stress, is that across all of these trades, there is a risk-reward balance. Okay, so just have a look at it. If, for example, I were to use this, which fairly represent that, the entry point in here would be this. We know that the minimum taking profit is going to be there, and that the stop loss is here. That means there is a ratio, risk-reward ratio of nearly 1. That means you're risking just as much as you gain. That means, well, to me, you're profitable so long as this thing has more than 50% chance of success. That's really the way it goes. If you're wrong, well, you're going to lose just as much as you would win. So the strategy is profitable. There's more than half percent chances, probabilities to be successful, which I think, like we said, Bitcoin has nothing to prove anymore. I definitely think this is a viable strategy. If I had $1 to oppose to this strategy, I think there are more chances to go there than there. So as I'm risking as much as I could win, I'm definitely on board with Bitcoin. When it comes to Ethereum, the same applied strategy would give us in here. Of course, I bought in here, though. As you can see, it didn't really last very long for Ethereum. So let's just be rational and say many people will buy this. Okay, then of course the stop loss is in here, and the minimum taking profit is going to be there. As you can see, we're at 1.5. That means that currently, in similar context of Bitcoin, Ethereum has better rewards to deliver. So same story. Have I bought more Ethereum than Bitcoin? The answer is yes. Obviously yes. Because I definitely think there is not a chance in this world in which Bitcoin succeeds and not Ethereum. Could happen. Like I said, they're not equal probabilities. So some people may make the different choice. I do not. I'm here for risk. You know I'm a trader. I'm not just here for the beautiful eyes of Bitcoin and Ethereum. On the other hand, well, if we were to look at Atom on a similar perspective, boys, you would see why, of course, Atom could deliver quite some rewards, but not at the expense of risk-taking. If I were to do this for Atom, that means we would have a 4.6 risk-reward ratio. That's triple the Ethereum's risk-reward ratio. So you have to understand the variable in here. If one trade offers more than 3 to 4% to 4 times the rewards, that means it has significantly lower chances to succeed. So that's really the way it goes. Don't just have your eyes full of sparkle and say, oh, I'm going to fall into Atom. No, the reality is that, well, the strategy just says that strategically speaking, these ones have far less success rates. So this is really the way it goes. You can take the risks, but just like I said, what I've done yesterday is balancing my risk. It of course depends on every investor's risk profile. My personal distribution in yesterday in terms of investment has been 50% Ethereum, 30% Atom, 20% Bitcoin. That's really how I created my personal mix of these investments. For Atom, it actually turns out to be a significantly different strategic because basically I've been taking on my rewards accumulated by the staking, and I have leveraged those rewards into Nolus. Nolus that is offering me a 150% margin on the collateral, which means I can take $1 of Atom that I own, and I can buy $2.50 of Atom with it. Of course, the one atom gets destroyed. So I get 1.5 additional Atom for each 1 atom that I can provide. And of course, it's associated with borrowing, which means I have a 14.6% interest to pay on the loan, But the beauty is that I can buy staked ATOM with it, which means I can still get the 19% rewards that ATOM is offering. So I get to pay 14% interest, but I also gain 90% interest. So this is still kind of a nice way to do things. And I think for those who want to margin their position, Nolus is offering the best on-chain experience I could find. Once again, I'm not just shilling the baby. I am advisor for Nolus. People know that. I have a financial agreement with them, which is nothing like I'm being paid. It's just that they've been delegating to a validator to compensate for this. But despite that, once again, do your own research. This is on-chain code, open source. You can see the thing for yourself. To me, this is just like an on-chain margin with not crazy fucking rate like a 30x. This is a 1.5x margin in here. This isn't crazy shit. So rather like to be making your research on this. I told you about this for transparency purposes because that's what I used. So once again, been using cash for Ethereum and Bitcoin, been using the rewards of ATOM and collateralize them with a 1.5 margin on top of it. So that's really the way it goes. Of course, that means I will lose ownership of these atoms if prices go below $5, which is anyway the technical invalidation that we have highlighted previously. What the future is going to be made out of, I would like to be honest, I don't know. Strategies like that are things that would apply. That doesn't matter to me if they're Ethereum, ATOM, Bitcoin, whatever shit that is. I could do this on any asset in the planet. So long as I have this pattern, an absolute longer term bottom in here, tested with the first flow, I'll buy the second flow eyes closed on the moving average and also as well on the Bollinger Bands when they're offered. Future will say if that's true or not. All I know is that the bots, the buy entries that have been performed in here, and in here have whole minimum targets of $17, and there's nothing I'm going to do before that happens. The only other outcome is invalidation stop loss, which is part of the game. I've taken stop loss in my entire career, still will in the future, and it's never going to change the strategy. All I know is that anytime I see an opportunity, I jump on it, and the future makes its decision. When you have a positively rewarding strategy, that means a positive expectation for gain over 100,000 trades, you just don't think of individual trades. I play this game on any asset that's put in front of me. So long as the pattern fits, I'm here to trade, period. So that's what I've done. Transparency purpose, of course, these strategies have been told in advance. I told you that if the market were deciding to go for the bearish Bollinger Bands, I would buy eyes closed, which is what I've done. That being said, I wish you guys a pleasant end of the summer season. I am now finished with all my job. I finished a report, which I'll publish earlier in September. Though I'm ready for another season with you guys. Starting by September, I'll go back to all the educational content and stuff, regularly stuff. Normally by next Monday, I should also be able to publish another weekly update in which we'll do the regular weekly update stuff, looking at the models which we consistently look out for in each and every Monday. So sorry, last Monday was off, but I'm going to be able to do one, I guess, on next Monday. By that, see you guys later and trade safe. Bye-bye.